you've had a really nice call for months now. You've been highlighting the relative strength that Netflix has shown since that gap that it had last spring over the course of the summer into the fall. You thought maybe that the price really kind of overshot the fundamentals and the opportunities here. Thoughts here, because you were saying before the print, before last week, I'd stay long this thing if you're long. You think they're going to put up a good report, especially relative to expectations, even though the stock had rallied so much. But you said that if we go in there, we fill in that gap, and you got that gap fill, you'd probably be a seller on the way out. Now, yesterday, you and I were talking about that because I asked you again, because the stock has just continued here. And we thought, well, listen, maybe we could kind of structure a little bit of an options trade for some of those long holders who still believe in the name and they don't want to let go of it so quickly. Thoughts here on the Netflix, and then I'll kind of detail a hedge idea I have in the name for long holders.
In the spring of last year, we talked about how for the first time in the history of the stock being a publicly traded company, it was trading at a valuation, and not only was cheap to itself, it was cheap to the broader market. And we said it's setting up as a value investment, a value trade, and we thought it could rally. And you pointed out the fact that we thought it could fill some of the gaps we made along the way to the downside. We thought they could fill them on the way back up. And 345 was sort of the level that I was targeting, and it happened. Now we've overshot to the upside. I think people are getting a tad too euphoric here. Remember, Reed Hastings is stepping down. He's obviously going to still be part of the company. It's obviously a bit of a transition there at Netflix. And the quarter was good, but if you really pull it apart, was it good enough to be supportive of, again, just sort of holding on to the move we've already seen? I suggest not. It's not saying that Netflix is broken by any stretch of imagination, but this is a trading show, and I think the trade to the upside is over. And now I start to think you have to look for the back and fill down to that uptrend line, which probably, given time erosion, takes you back down to 305, 310.
Yeah, and again, I would just say on that chart, I mean, you probably don't want to be long that stock if it breaks that uptrend. So one idea, and again, I love this structure using options for long holders of stock, especially when they want to continue to own something. They want to participate in the upside, but they want to define the risk of the downside. So it's called a collar, and some traders would call it a risk reversal. So I just want to lay this out here. So let's just say you're long 100 shares of Netflix at 360. Let's say you have some big gains. Again, this stock was trading 275 at the end of last year. So about a month ago or so, you would look to sell an out of the money call. You would take in that call proceeds of that sale, and you use it to buy an out of the money put. And what you're doing is the gains between the current stock price and that short call strike, that's what you would kind of take in between now and that expiration that you're targeting. And then to the downside, so you would have the gains of the stock up to that short call strike. And on the downside, you would have losses of the stock down to the long put strike. So that's called a collar. And so here's the example I want to give here versus the stock at 360, 100 shares long. You'd buy the March 320, 410 collar for even money. You'd sell one of the Netflix March 410 calls at about $6. You'd use the proceeds to buy one of the Netflix March 320 puts for about $6. It costs you nothing. As the stock moves higher, you're basically going to have gains, okay? But that call that you're short is also going to gain in value. And to the downside, as the stock moves lower, right, you're going to have losses of the stock, but you're going to actually gain in that put. Now, time is a really important point here. This is March expiration. Here we are at the end of January, a little more than a month and a half. And so, again, your best case scenario in March is that you would have gains of up to $50 between 360 and 410. Your stock could be called away if the stock was 410 or higher on March expiration. That's up about 14%. You could always buy back that short call to stay long the stock. You have losses of up to 40 between 360 and 320, and you're protected down below that long put strike of 320 here. So again, this is just a collar structure. It seems a bit more complicated than it is. It's selling an out of the money call and it's buying an out of the money put. And when I do this versus long stock, I don't want to spend a whole heck of a lot of premium to do it, guy.